With so many options, investing can seem like an overwhelming and complicated process. Being aware of common mistakes people make can help you secure your financial future. Hi there, I'm Kelly Keene, author and personal finance educator. And in this video, we're going to look at ways to help you protect your investments by revealing the top 10 investing mistakes people make. The first one is not knowing your end goal. There are different strategies for different goals. An investment strategy for buying a house, for example, will be different than one for retirement. Remember, failing to plan is planning to fail. Second, focusing on the short term. Realizing the potential benefits from investing is a long-term process. Long-term strategies may not make you a millionaire overnight, but they won't bankrupt you either. The third mistake many Canadians make, and potentially one of the most dangerous, is investing before researching. Always check first. Research the investment before you hand over your money to help you make an informed decision. Number 4 on our list of investing mistakes is thinking it's simple. If it were possible to consistently beat the market, analysts and brokers would all be millionaires and retired, and they aren't. Don't overestimate or ignore your abilities. Fifth is having too many or too few investments. Having too many can destroy the chance for good returns, while having too few increases risk. The reason to build a diversified portfolio with a broad mix of assets is that you can manage risk. Similar assets will react the same way to market fluctuations, so having different assets means that some of your investments may be zigging as others zag. For example, while the stock portion of your portfolio might take a hit if there are fears of a recession, bonds will generally react in the opposite way and shore up your portfolio. If your investments are too similar, they will end up reacting the same way, and that means you're at risk of losing a lot of your hard-earned money. On the other hand, too many investments is a classic sign that there's no comprehensive strategy to your portfolio. It's unlikely that you'll be able to understand your investments well enough to know when it's time to buy or sell, plus too many investments can limit your upside. Over the long term, a good investment strategy with a balanced amount of investments allows your portfolio to generate a higher return for a given amount of risk. Number 6 can be hard for some people to resist, and that's choosing investments based solely on a hot tip. They're often based on misinformation, and by the time you get the tip, the opportunity has passed. Building wealth takes time and patience. 7 on our list is investing based on brand loyalty. Just because you like their products doesn't mean the company is a good investment. Research is the only way to tell how good a company really is. Number 8 is panicking when the markets fall. Buy low, sell high. We've all heard this advice, but it's hard to do when the news is full of stock market turmoil or exuberance. Having a solid investment plan will help you remain calm when the markets fall or rise. Stick to your plan and wait for the right time to make smart moves. 9 is ignoring taxes when planning investment strategies. Different investments are taxed differently, and you also need to consider tax shelters like RRSPs and TFSAs. Taxes should play an important role in your investment planning. Speak to a qualified professional about taxation in your investment and financial planning process. And number 10 on our list is not knowing your risk tolerance. All investments involve risk. Your investment objectives will help you determine how much risk you should take. Making these mistakes can certainly lead to bad investment decisions, but even worse, in certain cases, you could be at risk of becoming a victim of investment fraud. Don't forget that you're not in this alone. There are a range of financial professionals in Alberta to help you with your investment needs. The ASC's video series on recognizing and avoiding different types of investment fraud can help. You can find these videos on the ASC consumer website, checkfirst.ca. For now, let's review a few red flags of fraud that you need to be on the lookout for when it comes to investing. Claims of high rates of return with low or no risk is one of the most common red flags of fraud. And it's important to note that we've been living in a low interest rate environment for close to 10 years now. So be wary of anyone offering investments guaranteeing returns of 7 to 8%. Even though 7 to 8% isn't sky high, if it's so much more than what the banks offer, you have to ask yourself why. Another key red flag is the promise you will profit like the experts. These experts may claim to have proprietary information to make you rich, but they are more likely to be out to steal your hard-earned money. If you can't find the person or company you are looking to invest in on the National Registration Search, then there is a chance it is a fraud. Always check registration using web tools like this. More about these and other red flags of fraud can be found at checkfirst.ca. Now you know about the top 10 investing mistakes, along with some common red flags of fraud to watch out for. For more information on investments and how to make informed decisions, visit checkfirst.ca.